Hello and welcome. My name is Mark Huber, and I'm the author of How to Get Rid of Your Mortgage and Create Wealth, the UnCanadian Way, which you can download at howtogetridofyourmortgage.com. Today I want to talk about dealing with a 40-year mortgage and how for as little as $12 a day you can pay off your 40-year mortgage in 21 years. I wanted to speak about this because I was approached recently by a young couple who had asked me for some advice as to their options and to how to get into the Vancouver market. And so I did, and now I'm passing along what I told them to you and trust that you'll find it a benefit. The advice and concepts are equally as valid, irrespective of the type or the length of mortgage that you have. As you know, there are more options today than ever before when it comes to home financing. And, of course, here in the lower mainland of British Columbia, the housing market is hot and people are finding it extremely difficult to even get into the market. However, for those that do, then they become fixated on trying to pay off their mortgage, generally to the exclusion of anything else. And I see this every day in that most people have a home, they have a mortgage, and maybe some RSPs, but that's about it. But before I get ahead of myself, let's just look at some numbers. This couple wanted to look at financing $331,000 over, in this case, 25 years. This would assume an $1,800 a month payment, and this column illustrates the $331,000 amortized over 25 years. Over here, and they were fortunate to have a hefty down payment in the neighborhood of $450,000. Nonetheless, this column illustrates the down payment plus the equity portion of your monthly mortgage as it's going towards the repayment of the mortgage. So, of course, in the 25th year, you will have repaid $331,000 worth of mortgage. And, in fact, you would have paid $221,000 in total interest to have repaid that $331,000 of mortgage. So that's obviously why a lot of people want to pay off the mortgage as quickly as possible to save themselves the interest carrying costs. But they're only looking at one element of the equation, in my estimation. You can see over here the equity building up over time that's giving a 0% return. And as time goes by, it doesn't increase the future marketability or resale value of the home here in the 25th year. These clients could be sitting in a home valued at $3 million, mortgage-free, granted. A few years out, when they're in their retirement years, the home would, of course, be paid off long ago, and the home would now be valued at $6 million. If this is their retirement game plan, they're going to have to look to sell the home and downsize and bank and or invest the difference to see them through their later retirement years. The difference between a 25-year amortization and a 40-year amortization with the mortgage amount that we're talking of $331,000 is $350 a month. That is the difference between the extended 40-year amortized mortgage and the 21-year. Now, the $350 a month can best be served by building equity outside the home, and I'll talk about that in just a moment. But here, again, is the amortization schedule on the $331,000 mortgage to the 40th year when the home is paid off, and you can see that the equity over time has built up as well. But again, it's trapped equity. It's giving a 0% return and is not helping in any way if push comes to shove, the family need cash unless they do a refinance and pull some equity out of the home for emergencies or opportunities. Again, irrespective of how they are treating their mortgage, whether they are mortgage-free or 25-year mortgage or 40-year mortgage, the housing market will dictate whatever the value will be as time goes by. And in this scenario, they could be mortgage-free in the 40th year and be sitting pretty in a home valued at $6 million. No different than over here. Difference, though, being is now they are brand newly mortgage-free the husband is age 79, the wife is age 84. This amortization column was giving her some distress because she felt that she would have to work until age 84 to have paid off the mortgage. And in all likelihood, that certainly was a possibility to consider. Nonetheless, my rationale was to, instead of taking that additional $350 a month and increasing their mortgage payment to reduce the amortization schedule to a 25-year AM, I suggested that they build the equity outside the home, whereby the $350 a month, which translates to approximately $3 a day, would allow them to get an interest-only loan for $70,000 at prevailing interest costs of, say, 6%. They're looking at, as I said, $12 a day, which would be $350 a month or $4,200 a year. Because they have borrowed for investment purposes, this amount is tax deductible on an annual basis, and to the tune of a total of $88,000 in the 21st year. As this is tax deductible, that will give rise to tax refund checks that they wouldn't have had otherwise, just under $1,400 a year, so that over 21 years there will have been a total of $29,000 of refund checks that they would have had. This column illustrates the $70,000 growing as time goes by. Additionally, this column illustrates that in any given year, if they were to pay off the $70,000 loan, this is the before tax investment portfolio value, and over here this would be the after tax investment value after loan is paid off. Interestingly enough, in the 21st year, they have a portfolio after tax valued at $252,000, which interestingly enough could go to pay off the 40-year amortized mortgage in the 21st year, because at that point the mortgage now stands at $228,000 essentially. The point is, they are in the driver's seat. They have the option of accessing a pool of capital to pay off non-tax deductible debt, which is their mortgage. Why would they do that? Well, because they have generated tax relief for themselves, they have generated tax refund checks for themselves, and they have the access to capital that they would not have had normally without the tax implications of cashing out an RRSP. Of course, one would not even consider that as a strategy to pay off a mortgage. Speaking of RRSPs, though, someone who feels the RSP route would be the preferred way to go if they had an additional $12 a day or $350 a month, which would translate into $4,200 a year, would give them, of course, the tax relief of $4,200 a year, so that at the end of 21 years, they would have received $88,000 of tax relief. Tax refund checks of just under $1,400 a year would again have given rise to $29,000 of total refunds. Same numbers that we have seen over here on this side of the ledger. However, with the RRSP, as you know, it's just a deferment of taxes. In any year that they so chose to cash out the RRSP portfolio, these are the corresponding dollar values that they would be left with on an after-tax basis. To compare apples to apples, I have just transposed the borrow to invest, after investment loan paid, after tax paid numbers here illustrated, comparing that to the net after taxes paid on cashing out an RRSP into this column. And lastly, this column illustrates that on a net after tax basis, the borrow to invest is greater than the RRSP strategy by these amounts on an annual basis. Thought you would find that interesting. I know my clients did, and they are now prepared to begin their wealth creation process utilizing their home, but utilizing the tax benefits of borrowing for investment purposes to give rise to tax relief tax refund checks, and ultimately a portfolio that will, in future years, give them the options and the opportunity to pay down any mortgage that is outstanding at that point in time, to pay off the mortgage, or to do nothing. It's their call. Nonetheless, in the interim, rather than having had to dip into capital that has been building up within their home, they have access to capital that they can access outside of their home, again, without the tax implications of cashing out RRSPs. They like the idea. They're going forward with the idea. And I thought I would share this with you today. If you have any thoughts or questions regarding this or anything else that's on your mind, feel free to call me directly, Mark Huber, at 604-207-9970, or alternatively, give me an email at mhuber@howtobesetforlife.com. I hope you've enjoyed the presentation and look forward to chatting with you soon. Bye-bye now.